Hey everyone, welcome back to the Daily Gold Podcast. We have a new guest today. I'm chatting with Christos Doulis. He's an analyst with StoneCap Securities, and he actually won an award, the Star Mine Analyst Award in 2011 for his stock recommendations. Hey Christos, how are you today?
I'm good, and thanks for having me on.
Oh, it's a pleasure to have you. Let's get started. Uh, First question I want to ask you, in your opinion, where do you see things trending right now in the metals markets? I mean, especially, and does today have any influence on that, given the huge declines we're seeing?
I mean, in the broader sense, I am not particularly nervous about movements in the metals market. I think that the trend for both silver and gold and precious metals is going to continue to be upwards over the next little while. I think that you'll see lots of volatility, and you'll see days like today where gold is down $40. But you'll also see the opposite, which is days where either gold is up $40 or you have a series of days where it's up $20 a day. So I'm still convinced that the long-term trend here is up for both metals, and I'm fully aware that we'll see a lot of volatility around an upward trend, but I'm not concerned.
Okay, now let's talk about producers because I know you cover a lot of producers. What do you think the market is looking for in terms of producers? And secondly, as an analyst, what are you looking for in producers?
Sure. I mean, the key that the market, first thing that you have to understand about where the market's kind of head is at right now in terms of the junior producing stories is it's all about delivering into the expectations you set for yourself. So if you go out there and you pound the table telling the market you're going to do X and you only come in at half of X, you get really heavily punished. If you come out and you say you're going to do X and you deliver X plus one, the market rewards you. And I mean, I think we see this in certain names that have commanded very strong valuations relative to their peers based on their track record. And I'm talking about names, for instance, like Argonaut Gold, which trading at $10.50 is trading at a very rich cash flow multiple relative to next year's cash flow, but has a track record of successfully executing on the projects in its stable, which has garnered quite a high degree of investor interest. What do I really think the market is looking for when it comes to junior production beyond executing on what you're going to do? I mean, I think what the market is still fixated on, given that there is some nervousness in the space in the metal space, is good cost structure. So kind of sub $900 cash cost per ounce, and I think 100,000 ounces is more appealing than 50,000 ounces in terms of a multiple, and I think 250,000 ounces is more appealing than 100,000 ounces in terms of a multiple. So I think you get bigger multiples as you go up the producing scale.
So is that what you personally are looking for? Just to confirm, you're looking for enough production so it'll get people's attention. At the same time, you're looking for management that can deliver on expectations and not essentially control costs.
Absolutely. I mean, when I look at companies, I look at primarily two things: the quality of the assets and the quality of the guys, the management that's going to be executing on these assets. So I look for both when I want winners on both sides of the equation when I look for names that I will consider for research coverage. When it comes to size and all that, I mean, I look for emerging production. And what I mean by that is guys who are either very close to production within, I'd say, 12 months, or have existing production now with a very nice looking growth profile. And that's one of the reasons I cover Argonaut Gold. Argonaut, only has one producing mine right now. Has a second asset that's kind of right on the cusp of making that transition from small-scale production to more significant production, but then has two further assets, assuming that they close on this acquisition of Prodigy, that will ultimately see them transform themselves from 100-ish thousand ounces of production to between 400,000 and 500,000 ounces of production. And as I said, this thing is trading at a very rich multiple relative to next year's cash flow, but the market certainly seems to be willing to pay for this growth profile and their track record of success at executing at La Castillo and to some degree El Castillo, I should say, and to some degree La Colorada, which is this other project that's right on the cusp from going from kind of small-scale production to larger-scale production.
Now, just to follow up on that, you don't have to mention any names, but I'm just curious: is there anything, because you talk about the high valuations that Argonaut is trading at? Do you see any smaller, maybe upstart type companies that have the potential to, in like let's say 12 or 24 months, get a much richer valuation?
Absolutely, and so some now I wouldn't exactly classify this name as an upstart. I classify it more as a turnaround that has yet to take the market, has yet to garner the market's interest. And the name that the company that I'm referring to is Sandgold. This was a stock that was over $3 a few years ago, and it's now sub a dollar. The lowest it's traded in the kind of last 52 weeks is in the, I want to say, 75 cents range, and it's been trading around a dollar right now. I think that at any prices below a dollar, I think it's a buy. And what has happened here is that after failing to deliver into very aggressive promises in the last 3 years, a new CEO was brought in, George Peary. He's since kind of focused really on the nuts and bolts of what they're doing and has delivered a couple of good quarters of production. They've spent a lot of money in both the mine and the mill upgrades, and I think that going forward, that's going to pay off. So, as I say, this is a stock where it was $3. I certainly wasn't aggressively recommending it at that level, but here at sub a dollar prices, I currently have a $1.65 target and an outperform rating. And I should tell you, I've just gone to that outperform rating and raised my target in the last couple of months on the assumption that the worst is over. Massive investments in the plant and the mine will pay off in the future. So Sandgold is one that I'm looking around as a turnaround story. Another one that's of a similar vein is St. Andrew Goldfields, which I've also just gone positive on. The reason I recommend St. Andrews is it is one of the higher cost producers, kind of $1,000-ish cash costs. A lot of that is from royalties that are sliding scale and are at current gold prices very significant. But what it offers, guys, is assuming that the gold price continues to run, this offers serious EBITDA torque around the gold price. A high cost structure, while it can make you nervous in a time of declining gold prices, when the gold price is going up, obviously their EBITDA margin widens faster than anybody else's. So assuming we are going to see the trend for gold continue upwards, I think that St. Andrews and Sandgold are two names that investors can look at in the emerging production space.
And let's just turn and talk about exploration and development projects. I think you focus mostly on the producers, but it's so interesting to so many investors and people who follow the space. You have some companies are trading at $25 per ounce on the ground, and then you see companies being taken over for $300 an ounce or $200 an ounce. I mean, what do you make of that, and how can onlookers and the non-experts, how can they really get a handle on what they need to be looking for in these exploration and development type projects?
Well, obviously, the exploration space is a very exciting one in that the kind of the game plan for a long time in the Canadian mining space for the developers has been build and sell, and that's where you can command nice juicy return when one day you're trading at $1 and the next day a bid comes in at $1.25 or something along those lines. So certainly, I'm aware of how exciting and intriguing that space can be for guys. When junior investors are looking at the development space, I suggest that one of the things that's critical is size, in terms of size of deposit. So, for instance, the acquisition I just talked about, the Prodigy acquisition by Argonaut, I mean, that was a kind of 5-ish million ounces, 5 to 6 million ounce acquisition, which is very, very significant. Some of the smaller names, are trading at much smaller multiples, and that's on a per ounce basis, and a lot of that has to do with size, although obviously some of it is also quality of management and deposit. What I think guys should be looking for, in addition to size, is well funded. The market is still very pessimistic, and it's a very tough market for the developers. So you want to see guys who have a fair amount of cash on the balance sheet in order for them to execute on a good exploration program. And then you obviously have to get into the nitty gritty of trying to decide whether management is the right horse to bet on. And there are no simple answers to that one. And then obviously, for guys like me, the numbers associated with the project also come into play, and it's hard once again to kind of have any fast and hard rule, but I would say a general rule of thumb that you want to see is, if you're good at doing costing benefit like analysis, if you think it's going to cost $100 to move a ton of ore out of ground and get it into a mill and process it, you want that rock to be worth $200 in contained metal. So that's when I look very quickly at projects, I do some quick estimates of what I think it might cost them to process stuff, to mine and process a ton of ore, and what that actual ton of ore is worth. And as I say, the margin for me is, if it's $100 to mine and mill, I want it to have $200 of metal contained value.
Okay, now stepping back from that, it seems like the last couple of years, the Argonaut types, the junior producers, the quality ones have really been the outperformers. I mean, you look at the large caps; those stocks haven't done much in over several years. And then, of course, the exploration space has been very difficult with two downturns in the last 4 or 5 years. I mean, over the next year or so, do you think the junior producers are going to continue to kind of lead this bull market?
Well, I think that a lot of it will be commodity price dependent. So, once again, it all comes back to where is the gold price going over in the short term. If the gold price trend continues upward, I think that you will continue to see the intermediate producers outperform some of the senior guys. But obviously, the downside of that is if the gold price weakens, I can see them outperforming negatively relative to some of the other senior producers. So, assuming that the gold price continues to head upwards, which is what I believe we'll see over the medium term and the long term, I think that the junior producer space, if you choose your companies well, you generate superior returns relative to investing in a Barrick or a similar entity.
And Christos, as we close here, is there any way our public listeners can follow your work, or do they have to be a client of StoneCap?
Absolutely, guys can have access to my work. We are an institutional brokerage firm, so the focus is not on the retail account. We don't have any retail guys, brokers that is here. But if guys are interested in my work, I encourage them to reach out to me via email, and I distribute my research freely to the retail public, no cost. And I'm also, when I have the time, I'm always willing to answer a few questions from the retail public about names that I cover. And my email address for those who are curious, I'm assuming you can include that with this interview.
Yes, I will include that. Christos, anything else you want to mention before we close here?
I think that the whole game here has not played out in terms of the precious metals complex and investing in it. We lived beyond our means for 40 years when the Western economies went off the gold standard and expanded our monetary bases. And in the last few years, we've redoubled our efforts to expand the money supply. So from my perspective, I don't think that we're in a bubble here, and nor do I think that this trend for the metals prices is over. And I think that the guys would be well served to look at the precious metal space as a place to invest, particularly in light of the broad economic circumstances out there.
All right, Christos, thanks so much for your time today. I really appreciate it. We'll have to have you back again soon.
Thank you for taking the time to speak with me.